Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. In Australia today, we saw GDP growth come out at just 0.9%. The market was expecting 1, I was expecting 0.8, so it came out in the middle of 0.9. Not a lot of disappointment, but not a lot of encouragement either. I know some people are trying to spin it up into some fabulous number. But the previous quarter was revised down to 0.7%, so it's 1.6% growth in the first half of the year. Very respectable for the Australian economy, but nothing quite to party about either, as some seem to be doing. What was interesting is that fixed investment actually contracted in the second quarter, and also government spending declined in the second quarter in terms of its impact on the economy. So having a negative impact, in fact, that decline. So I think the reality is that the first half of the year hasn't really felt the full force of the RBA's interest rate increases, hasn't felt yet really, it hasn't gone through or permeated through the economy fully. The higher food and energy prices. We've seen some wage gains to offset those. We've got a little bit of a wage inflation spiral happening in Australia. One of the things we can be very sure of, though, is that inflation is very high and going a lot higher, maybe 7-8% for Australian inflation. So watch out for that. It's nice to see oil prices falling back. Let's hope they continue to fall back. The recent OPEC meeting, though, suggested that OPEC is looking to put a floor under the oil price, which could mean that prices at the Port-Vila are about as low as they're going to get this or next month, and then perhaps start to move higher again. But the big factor, I guess, really is the Reserve Bank of Australia. It was very slow off the mark. Remember, a year ago I was saying they should be hiking interest rates gently while the economy is strong and before inflation runs away. They were saying inflation was transitory. The RBA was saying that inflation wasn't going to come to Australia in the way that it had to the rest of the world. They were, of course, wrong on all of that. And you'll also remember that a year ago I said the Reserve Bank will probably be stupid, not do anything until next year, and then it will have to raise interest rates aggressively to chase the horse that's already bolted, being inflation. And that's exactly what we are seeing at the moment. The problem is that in the RBA's mind, current interest rate levels, even after all the hikes that we've seen so far, are still really at stimulatory to the economy levels, which means fueling inflation. Therefore, the RBA, as it said in its statement, is going to be hiking interest rates to much higher levels. In fact, the worst case scenario could be as high as 4.5% or 5.5% for the RBA cash rate, which has mortgage rates considerably higher than that. So that would be a case of extreme mortgage stress sometime in the next 6 to 12 months. So what I'm trying to get to in regard to Australia's GDP numbers is that even though they were good, they weren't overly strong, but they were reasonable. But that is probably as good as it gets for the Australian economy for the rest of this year, and probably well into, if not through all of 2023. There's a whole lot of negative economic influences happening around the world at the moment that still are percolating into the Australian economy. And those numbers are appreciated that we saw today, 0.9% GDP, but we probably are going to see lower numbers for Q3, Q4, with risk to contraction Q4, Q1, Q2. So I remain an advocate of the surprise recession risk still being on the table. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.